All right, FUs and manipulations. Okay, FUs and manipulation. FUs, write this down. FUs, okay, are your key and the most important part to understanding institutional manipulation. Okay, FUs are your key and most important part to understanding institutional manipulation. Again, what I'm teaching you, the concepts that I'm teaching you are how to trade alongside the banks. Okay, we're no longer trading or thinking like retail traders. We are trading and thinking like institutional traders. With that being said, we identify manipulation in the market, right? And we always follow manipulation. Okay, always follow manipulation. So this chart here, okay, I'm literally going to go through and we are going to identify some FUs, okay? And I'm going to explain to you why they are FUs. All right. So this right here is the S&P 500 daily chart. Okay, futures contract daily chart. All right. So this is the first one that pops out here. Okay, is this a FU to the upside or is it a FU to the downside? Okay, it's a FU to the downside. Okay, now what constitutes this as a FU to the downside? Okay, now in order to determine if it's an FU or not, right, it requires us to take a look at two bars at one time. Okay, it requires us to take a look at two bars at one time. Okay, in this case, this green bar is bar number one. Okay, and the red bar is bar number two. Okay, now which one is our FU? Which one actually formed the FU? Yep, bar number two. Okay, so it requires us to take a look at two consecutive bars. Okay, and it also is determined by bar number two. Bar number two. Are we all on the same page there? All right, good. Now, why is this a FU? Well, let's talk about candle composition in the basics. Okay. Now, on each bar, okay, every single bar, we have liquidity above it and we have liquidity below it. Okay, every single bar, there's some sort of liquidity above and below the bar. Okay, now with bar number two, okay, it being a red bar indicates that the market moved in what direction? Down. Okay, red bar indicates that the market moved down. Okay, and the green bar indicates that what? Any green bar that we see indicates that the market moved what? Up. Okay. Now, in this FU, we got liquidity here. Okay, and we have liquidity there. Okay. Now, this is a FU because the subsequent bar or the very next bar or the bar that forms the FU came and did what? Traded above the high of the previous bar. Okay. We traded all the way up here. We traded above the high. And then what? We reversed and started to do what? Sell off. Okay. So this constitutes as a FU to the downside. Okay. Tony, I'm going to get to that. All right. Now, let's take a look at these next two bars here. Okay. This is an FU to the upside. Okay. Why is this a FU to the upside? Because the market, the very next bar, traded below the low of the previous bar, reversed directions, and went what? Higher. Okay. So it grabbed liquidity on one side of the bar. It reversed directions. Okay. And in this case, it reversed directions higher. Okay. It reversed directions higher. Does that make sense? Okay. So this is institutional manipulation. These FUs are institutional manipulation. All right. Let's zoom in to here. Here's another one right here. Okay. Bar number 2, it did what? Broke below the low of the previous bar, and it reversed directions to do what? Go higher. Okay, this is a FU to the upside. Okay, now there's two types of FUs. Okay, there's two types of FUs. One is stronger than the other. Okay, the first type is an attempted FU. Okay. Attempted FU. Okay. And what makes it an attempted FU? An attempted FU is, for example, both of these are attempted FUs. This one, okay, and this one, okay. Both of these are attempted FUs because it did not close, bar number 2 did not close below the body of bar number 1. Okay. Bar number 2 did not close in the second FU. Bar number 2 did not close above the body of bar number 1. Okay. These are attempted FUs. Okay. These are your weaker forms of manipulations. However, still very important, still very key. You can still draw very valuable information. Okay. And what? The clear direction in the market. Now let's look at a true FU. This bar went what? Grab liquidity above bar number 1. Okay. Reverse directions, and did it close below bar number 1? Yes. Okay. Yes. So these are your strongest forms of manipulation. Okay. And we can see it here. Look at the very next day, we came and did what? We had a retest of what? The FU, and a nice move to the downside. Okay. And a nice move to the downside. Almost 100-point move. Okay. The retest of this daily FU was almost 100-point move. Okay. Almost 100-point move. 100-point move is $5,000. Okay. So one contract on 100-point move would have made you $5,000. Just trading one contract. Okay. One contract. So these are very, very, very powerful setups and our cornerstone to our process and to our understanding of manipulation. Okay. Let's take a look at this one right here. Look at this one right here. We came and grabbed liquidity above it. And then did bar number 2 close below the body of bar number 1? Yes or no? Yes. Okay. Yes. So now from a swing trade standpoint, look how it started this entire move to the downside over the next couple of days. Okay. Almost a 200-point move over the course of the next trading week, all started off a FU to the downside on your daily time frame. Okay. Yes, that's a perfect FU. Okay, because it closed below the body of bar number 1. Okay. If it closes below the body, it is a perfect FU. If it closes above the body, when we start talking about an FU to the upside, these are your stronger FUs. Okay. We want to focus on the body of the candle. Okay. We want to focus on the body of the candle. You say, what about the retest? Okay, well, so I'm not necessarily going over, we're not necessarily talking trade entries right now, Nicole, because again, this is just the daily time frame. If we zoom down into the 60-minute or the 4-hour, I'm sure we would have found possible trade entries on those time frames where FUs to the downside were retested. All right, let's take a look at the zoom down time frames. Let's look at the 4-hour time frame. All right, let's take a look at this. Is this a FU to the upside or FU to the downside? To the downside. Okay, to the downside. Okay. Now, is this an attempted FU or is this a strong FU? Good. It's attempted. Yes, it's attempted. And it's an attempted FU because we did not, bar number 2 did not close below the body of bar number 1. Okay. Now let's take a look at this one. Is this a FU to the upside or FU to the downside? Good. Downside. And is it a strong FU or is it an attempted FU? All right, good. Now let's see who can figure this one out. We got an FU in what direction here? Yep, to the upside. Now, is this a strong FU or is this a weak FU? Good. It's a strong FU. Okay. So the wicks, okay, this is the thing about the wicks. With the FUs, you need to focus on the body. Okay. Candlestick basics. Let's go over candlestick basics right here. Okay. A green bar is what direction? If you see a green bar on a chart, what direction did it go? Okay, up. Okay. Now, on a up bar or a green bar, the bottom of the body is the opening price. Okay. And the top of the body is the closing price. Okay. So we're looking at a 4-hour chart. Okay. The bottom of the bottom of the body. Okay. And the body equals the colored area. Okay. Body of the candle equals the colored area. So how do you know it's the body of the candle? Okay. Only the body is colored. Okay. Now, if we see a red candle on the chart, is that an indication of a up move or a down move? Good. Green is up. Okay. Red is down. Okay. Now, on a down candle or a red candle, the top of the body is your opening price. Okay. And the bottom of the candle is your closing price. Okay. Red, good, Kim. Red opens high and closes low. Okay. Green opens low and closes high. Does that make sense, newbies? Okay, cool. That makes it clear. Sweet. All right, good. Okay. So what we're focusing on, okay, when it comes to the FU is, did the body of the candle close above the body of the previous candle? Okay. Did the body of the candle close below the previous candle? Okay. Closing price was here. Okay. And the previous body close was where? Or the low of the previous body was here. Okay. So this is a strong FU to the downside. Does that make sense? All right, good. And we see it on every time frame. Every single time frame, we can find this manipulation. Now, look, I'm looking at the 1-hour time frame of the S&P 500. Okay. Going into next week. Okay. So when the market opens on Sunday, what direction do you think I am going to be going in? Good. Okay. Good. I am going to be going short. Okay. My higher time frame, okay, inside of my sell zone has formed a 1-hour FU to the downside. Okay. Now, this FU to the downside, is it a strong FU or is it a attempted FU? Denise, yes, they can be both colors for sure. Yes, it's a strong FU. Okay, it is a strong FU. This is the body. This is the bottom of the body of candle number 1. Okay, and did we close below the body? Yes or no? Yes. Okay, so it is a strong FU. Dosey, we're not talking about the wicks again, okay? We're talking about the body of the candle. We're focusing on body to body, okay? How does the body of candle number 2 relate to the body of candle number 1, okay? This is the body of candle number 1, just this area right here, okay? Just that area right here. Did candle number 2 break below it? Yes, okay? Yes. Okay. Tony say, how can we tell the difference between an attempted FU? That's a doji being an FU up to buyer, being a liquidity to target. Okay. Well, Tony, again, we're talking about the bodies. Okay. This is a doji. Okay. So guess what? Didn't we grab doji liquidity, right? And did what? Form the FU to the downside. Okay. So this makes it an even more powerful setup. And we're not talking about, I'm not really diving into the setups right now. Okay. I literally just want this video to be about FU so you all can understand what a FU is. But this is a powerful setup because it did what? It grabbed doji liquidity. Okay. And did what? Formed a strong FU to the downside. Okay. It grabbed doji liquidity and formed a strong FU to the downside. Don't worry, let me go through this for about 5 more minutes and then I'm going to open it up for questions, all right? Now look at this on a 1 hour time frame. Three consecutive strong FUs to the downside. Okay. 3 consecutive FUs to the downside. So this was on a 60-minute chart. So this was a clear indication that what? That the market was going to do what? Continue lower. Okay. This was a clear indication that the market was going to do what? Continue lower. Everybody see that? Does everybody? Now, was this a strong FU? FU number one, was it a strong FU or an attempted FU? Yep, it was a strong FU. The red candle closed below the body of the green candle. Candle number two, was it a strong FU or a attempted FU? Good, strong FU. Okay. Number three, was this a strong FU or a attempted FU? Good, good, strong FU. Okay, strong FU because what? It closed below the body of the previous candle. Okay, it closed below the body of the previous candle. All right. So let me open it up for questions. Again, this is recorded, so you all are going to have the opportunity to go back and watch this. This is literally all there is to an FU. Okay, and we're not going to make it more complicated than it needs to be, but I definitely want to open up the floor for questions so we can clear up anything that isn't clear. Okay. All right, Tony. Yep. Let me get to the participants. All right, Tony, you got the mic.
Okay. Hey, good evening, Coach. All right, I just wanted to talk to you about my question, just to give a little more perspective. So
Yep.
do you see that doji right there at the between 7 o'clock and 10 o'clock? There's a red doji.
This one right here?
Go to the left. You'll see it's basically at the top of the move, like between 7 o'clock and 10. Oh, I'm sorry. The other 7 to 10. Go back a little further.
Over here?
Yeah, that one.
Okay.
Okay, so here my thing with that one, right, is that looking at that, if before that, well, I mean, looking at it, you're going to look at that as a high liquidity doji, right?
Mm-hmm.
But it's also a attempted or failed FU down. So these situations are the ones that throw me off, because if it's a high liquidity doji, I would be looking to buy that. But if it's a FU attempted down, I'd be looking to sell. So I run into those sometimes, and they kind of throw me off when they're attempted. Like, I can't clarify if it's an attempted FU or if it's a doji to target.
Okay, and you can clarify. We just got to get you some more understanding, and you will. But I understand what you're saying. So, all right. So let's talk about this one, right? Because the one I got circled is what you're referring to, right?
Yeah, I just saw this one on the chart.
That's cool. So explain to me your logic as to why you would buy here. And guess what? You're not, if you don't have it fully together, the concept is still fairly new. I understand. I can see why you would possibly buy here, but I want to hear it out of your mouth.
Because for one, I see the FUs leading up. I see the FUs leading up to it. So, but I guess in real time like that, doji wouldn't. Well, I don't know if this is the best example, but
no, but no. This is a good example, because these are things that take place real time in the market, right? And this was something that came to you and stood out. So, like, let's get some clarity on it.
Yeah.
Okay. So, all right. So let me say this, right? So prior to this attempted FU, right? This is, we all agree that you agree that this is an attempted FU to the downside, right?
Yeah.
Okay. And we're looking at the 1 hour, and we're looking at the 1 hour time frame. Okay. Now, I do understand why your initial thought could be a buy. Okay. Because the 1 hour time frame prior to that was a what?
FU up. Yeah. And the one couple candles behind it.
Yeah. Okay. So this was a strong, and they were strong FUs to the upside, right?
Right.
Strong FUs to the upside. So FUs, write this down. FUs equals low liquidity moves. Low liquidity moves equals no reason for institutions to target.
Okay.
Okay. All right. So we had two strong FUs on our higher time frame, on a 60-minute time frame. Okay. And then we came back at the top of the move with a attempted FU, a weaker FU to the downside. Right? You see that?
Yep.
Okay. So now what would keep me out of a buy? Just because I have a tip, because again, hindsight is 2020, right? Just because I have an attempted FU to the downside, I don't automatically sell, right? Now, all of this is history. So again, we will look at it and say, man, it's attempted FU. We should have just sold because it took the market all the way down, right? That's not the case, and that's definitely not how it unfolds in real time. Okay. So again, this is why patience is key. Okay. Now, if I have a 60-minute, I want you all to write this down. If I have a 60-minute FU to the upside, whether it's strong or if it's attempted, only a 60-minute FU can negate it. Okay. Or two what? Two 30-minute FUs. Okay. So if I'm looking at a 60-minute FU to the upside, the only thing that can negate that is a 60-minute FU to the downside. Or two 30-minute FUs to the downside. Right? Because if we add 30 and 30, that gives us what? 60. Right? Okay. Now, would I have taken a sale just because, and I want you to answer this, would I have taken a sale just because of this attempted FU to the downside?
Well, I know I wouldn't have. I would have still been
Yeah,
buying.
you
So
probably
no.
would have stopped still trying to be long.
Yeah.
But this is what a big part of trade management. Okay. And this is a big part of the psychological side of getting off of your bias. We got two strong FUs, and you just think, oh man, it's going to go to the moon, right? But the market, remember, the market can do anything at any given time.
Right.
Okay. So what causes me to tighten my stop, Gary? What causes me to move my stop into profit when the market gives me an indication that we might be going the other way? Because even though it's weaker, an attempted FU is still manipulation. Okay, but guess what? If I were you, I probably would have been long in the trade too. But as soon as I seen this form on my larger time frame, okay, I would have been managing my long position, knowing that there is a higher than usual probability that we can go lower.
Okay.
Okay.
Yeah.
So
Okay.
now what would cause me to get in a short? What would cause me to get into a short?
So basically probably looking on some smaller time frames in this 60-minute to look for some other
Or
confirmation.
let's just talk about this one. It's 60-minute. What would cause me to eventually get short? Good, Nicole. A retest. You see how?
Oh yeah. Okay, I
You
see
see
that.
how the very next candle,
Yeah.
we came and retested this attempted FU and started to do what? Move lower.
Gotcha.
Okay.
Yeah.
We moved lower than the body of this one, and we moved lower than the body of the FU to the upside that form.
Okay.
That makes sense?
Yes, that makes sense. I'm so used to looking at like the strong FU,
Yep.
or even the attempted FU. I'm used to that too, but I'm so used to seeing dojis in a different light that I think I missed the retest on the dojis because I'm so used to them being areas to target,
Right.
not to bounce off of price and go the other direction. So I gotta change my mindset with
Yeah,
that.
just
Yeah, that helps.
yep. The more you look at it, the more it's going to come to you. But understand this: our most powerful setup with the FU is a retest. We don't necessarily just jump into a trade because an FU forms. We don't just find FUs and say, okay, it was an FU to the downside. Now I'm going to sell. Okay. Our most powerful setup is a retest of the FU. For example, look at this right here. And what I'm showing you now is actually our most powerful setup. What is this? A FU to
down
the downside, right?
It's strong.
Okay. This second FU to the downside came and did what? Retested our first FU, and then it made an FU itself. Okay. So this is what I call a high confirmation setup. And y'all always have a way of pulling the surprises out of me. But this is at the end of the month. I have a high confirmation setup indicator that is going to be available. Okay. The high confirmation setup is a retest of a FU that then forms another FU. Okay. These are our highest probability trade scenarios. This is what I call a high confirmation setup. Okay. Our most powerful setup is always going to be a retest of an FU. This gives us, and this is why it requires us to have patience in order to do what? In order to enter the trade. Okay. Makes sense?
Yes, thank you. This helps a lot because I don't really usually trade off of the dojis like this because I wasn't really kind of wasn't really sure, so this definitely helps. Thank you.
Right.
Well, one more question, because we did
Yep,
talk
go ahead.
about this in the Discord today with the FUs. I know I asked you this morning about color of FU, so you can buy on a red FU, you can sell on a green FU. Can you just show an example? We were talking about that, and I was like, I would like to see in real time like how that work, because I've never really traded like that either. So
Okay. Let me find one real quick.
I got you, Misha. No problem.
Okay, here we go. Is this a FU to the, is this a FU to the upside, or is it a FU to the downside?
Apparently this is a FU to the downside. Right? Yeah. Yeah, it's FU to the downside.
Yep, it's a FU to the downside.
Okay.
Okay. And why?
Also a doji.
Yep,
Yeah.
it came and grabbed liquidity here. Okay. It came and grabbed liquidity above that candle, and it came and grabbed liquidity here.
Yep.
Okay. And what, we had a strong rejection after liquidity was grabbed.
Mm-hmm. And then it was retested.
Okay. Tony, yes, because it grabbed liquidity. Okay. And it was and after it grabbed liquidity, it was a strong rejection in the opposite direction. Okay. Now, would this be considered a strong FU or an attempted FU?
An attempted?
Yep. Okay. Atay Israel. Yes, retest is still the body. Okay, we retested the body of the candle. So for example, okay, a retest would be this next candle coming to do what? Trade at the top of the body here and then moving down. Okay. And it's going to come to you, Daisy. It's going to come to you. It was something else I wanted to show you all that I seen. All right, it'll come back to me. What's next question? Thank you.
That's it. That's all I got. Thank you so much, Coach.
Okay, cool. No problem.
All right.
Gary, you got the mic.
All right, what's up? Yeah, so it was a great question. The previous question was a great question. My question leads off of that because I have a different perception on how to actually handle the situation that we had, that we circled. You know, we're still on this 12 o'clock candle that we're still on the same candle that she just mentioned, Tony, right at the top, this doji. So in the morning time,
What, this one right here?
Yeah, circle that one again. So
okay.
In the morning time, before the market opens, you know, we got to mark our levels. So in the morning, what I'm doing, and I know that this is an attempted FU, but I also know that this is the doji. So this is where my confusion comes. So the thing is that I'm always putting the green line at the top of this candle, the very top of this wick. It's a green line. And I'm saying to myself, like, okay, this is doji. The market actually likes to target these dojis and take them out. So I'm like, okay, high probability that this is going to be taken out, but this is also an attempted FU. So it's like a situation where it doesn't correspond with my first train of thought and logic that the market is actually not going to take it out, but it doesn't care to actually target it at all. Because now it's an attempt at FU. So how? So I guess like when we mark in these dojis, is this the doji that we mark as a green line to say that this is actually going to be taken out, or are we looking at this more of as an entry point for an attempted FU most of the time? Like which one is happening?
Okay, okay, good, great question, Gary. Okay, it's actually both. Okay, so don't overthink it. This is still doji liquidity up here. Okay. But let's keep it simple. Can a doji form a FU or not?
It can.
It can. Okay. Yes, it can. Okay. So that doesn't negate the fact that this is still doji liquidity. And guess what? This is major liquidity. Why?
Major liquidity because we don't have confluence on a lower time frame.
We don't have. We're not looking at the lower time.
Yeah, right. Okay. That's what I'm going off of.
But it's major liquidity because after the doji, we had an instant drop in the market.
Right.
Okay. It's major liquidity because we're on a larger time frame. Okay. We formed the doji, and we had an instant drop in the market.
Well, I see what you're saying.
Okay. Now let's. Boy, y'all always got a way of pulling. This is what I
go through in the morning. This is like one of the confusion that I go through.
So I think it was Nicole. Nicole asked me, how do I draw the FU zones, right? So this is our FU. This is the attempted FU, right? So I want the top of the body, okay, and I want above the wick of the previous candle, or above the high of the previous candle. Okay, that's my zone. That's my sell zone.
Okay.
Okay.
This is something I learned today earlier when you were talking in the morning about this buy and sell zone too, when it's like the wick on both sides.
All right, and then I'm going to put my money line up here because we on a larger time frame, and that's a doji. So yes, that's also what? Major liquidity.
Right.
Okay. Okay. So now what you have me explaining, Gary, is calculating liquidity. Okay. Y'all write this down since Gary got me talking about it now. Okay. Calculating liquidity means knowing what liquidity the market is okay with leaving behind. Okay, because the market can't get all of the liquidity all of the time in one direction, right? The market will leave liquidity behind sometimes. Okay, so calculating liquidity is all about understanding, okay, what liquidity the market is okay with leaving behind. All y'all got that written down.
So just to reiterate, calculating liquidity is knowing what liquidity
the market is okay with leaving behind. And clearly, the market was okay with doing what? Leaving that major liquidity behind for the time being, right?
Now, is there a probability aspect to this that is more or less grabbing it versus retesting?
Let me finish, Gary, and I'm gonna give you everything you need. I promise, like I always do. All right. So now we're looking at the 60-minute time frame. Okay. So how do I know if the market is okay with leaving this liquidity behind? Okay. I go down. What's my next time frame below this?
30 minutes.
30 minutes. So let's go take a look at the 30-minute time frame. Do I see any manipulation, FU manipulation to the downside anywhere in here?
Well, I mean, that doji right there, like that one, is that even what is that? Like,
no. Do I see any FUs after this zone form on the 30-minute?
No.
No, right? Yeah. All right, so let me go to my 15-minute time frame. right? Because in real time, we operating what off the lower time frames.
Right.
Now all of a sudden, look how our 60-minute doji was formed. Okay. And then look how it came back. And what else do we have here now?
We got a full FU going on.
Okay. Our 60-minute doji was formed with the 15-minute FU. Okay. And it was followed up. That's a plus sign. It was followed up by what? Another 15-minute FU to the downside.
So this is how we get that confirmation. No, like it's definitely not going after that doji.
Right. So
well, I won't say definitely because definitely anything can happen, but more than likely not going after.
Right. So let's keep it simple. Okay. Liquidity left behind. We're gonna call that LL plus an FU equals okay with being left behind.
Okay. So we still mark them.
We still mark them because Gary, look where did we trade today? Where did we trade today?
I'm not following on that question.
I'm saying, where did the market trade? Where did the market trade today?
It looks like it's going down, like that. I'm down, right? Or
hold on, let me show you.
Like we ask you, I'm trying to figure that out.
I'm saying it left that major liquidity behind, right?
Okay. Yeah.
But look, then we came and what? Took it out. Okay, it was trading days later, but it was major liquidity that was left behind that the market eventually did what? Came back to take out.
I got you.
Okay.
Mm-hmm.
And again, this is a video that you're going to have to go back and rewatch for sure. Okay, everybody.
Definitely.
Because these are advanced concepts, but I definitely want, these are important.
Okay. Well, thanks for clearing that up.
Yep. All right, next question. Craig, you got the mic.
Peace and blessing, brother Chris. Can you hear me, sir?
I can hear you. How you doing?
I'm all yourself.
I'm well.
I'm somewhat of a newbie. I was with you when through the BWO.
Okay.
And, but I didn't finish all the training courses, unfortunately. But along the way, I have been trying to study up on how to trade. One of the things I wanted to ask you about is the Candlestick Bible, and in that book, it has a chapter called Dojis. But one of the things I remember, it talks about different dojis, like the morning stars, the evening star dojis, the dragonfly dojis, greystone dojis.
Right.
My question to you is, does none of that matter? Are we just looking for candlesticks that has wicks on both ends?
Yeah.
To consider as a doji?
None of that in the Candlestick Bible matters outside of understanding where the bars open and close. Okay. If it's a dragonfly doji, if it's a traditional doji, if it's a rising star doji, a hammer doji, guess what? We're going to mark that as liquidity. Okay. Because the key thing to take away from a doji is dojis signal reversals to the retail public. Okay. So yes, whether it's a rising star, a hammer, dragonfly doji, whatever the case might be, guess what? The retail looks at that as a form of indecision in a possible reversal area in the market. Okay. So with that being said, dojis always generate liquidity. Okay. Gotcha. So we don't have to get inundated with the details or the styles or the type of doji. We want to keep it simple. Dojis generate liquidity. Double tops and double bottoms generate liquidity. Guess what? Institutions target liquidity.
Okay.
Got it. Julian, don't even worry about what book it is.
Yes, sir. You know what? And I hope I pray,
No,
man. I'm
no, no.
not causing no confusion.
Yeah, yeah.
Brother.
It's all good. It's all good. That's why we here. That's why we
Yes,
here.
sir. My man, I appreciate you, brother.
Yeah, I
Chris. Thank you,
appreciate
sir.
you. Yeah.
Yes, sir. All right.
All right. Next question.
Well, Dr. Cole, can you hear me?
Yeah. What's going on,
No,
Gary?
I thought you muted me or something like you didn't want to talk to me. Well, hey, so on the well, since we're here already, just like looking at that candle, this red candle at the far right, can we go? I just want to go down one time frame. I just want to see this because this is the same example from earlier.
What? This one right here?
Yes, this is all going to be recorded on the same video. I just want to look at the time frame below this one at that period.
Okay. So you want to look at the 60-minute?
Yeah.
Okay.
Okay. So I'm just looking to see like what formation. I just wanted to look to see what
So
formation.
60-minute. Okay. So okay. Boom. Let's see the makeup of this. Okay.
Mhm.
Let's see the makeup of this. We got a 60-minute FU to the downside. And is it a strong FU or is it an attempted FU?
That's a strong.
It's a strong FU. Okay.
Mhm.
All right. So let's zoom in. Let's go down to that's a 60-minute. Let's take a look at the 30-minute to see how it was formed on the 30-minute.
At the attempted FP.
30-minute is a what?
Attempted.
Okay. But then also what? What do we have?
A drop. No, not a drop, but
Not
a retest.
a retest. Okay. A retest and a further move down. Now let's take a look at it on the 15-minute time frame.
Yeah, here we go. All right, so
Doji liquidity. Okay, Doji liquidity on the 15-minute time frame. Okay, but we got a attempted FU on what 30-minute time frame and a retest. So somebody asked, so okay, that's what was you jogged my memory now. Somebody asked me what would negate it. Okay, so understand this, right? Because the person who was asking me the question when you was asking it with the wrong context. Negation means the opposite direction. Okay, so negation means what would cancel it out. Okay, what would cancel it out? And again, we keep it simple. Only a 1 hour. Let's talk about a 1 hour FU. Okay, a 1 hour FU can only be negated by another 1 hour FU. Okay, or two 30-minute FUs. Okay, if we see a FU on a 30-minute time frame, what type of FU can negate it?
15 minutes. It'll be what you said. If it was a what?
30-minute time frame.
Okay, so I'll say 15 minutes. We go up. We're going to the opposite direction.
No, what 30-minute time frame? Only a 30-minute time frame FU can negate it.
Okay.
Or two 15-minute time frames. Two 15-minute FUs.
Yeah, that's what we're doing. All right.
Okay. On a 4 hour time frame, what can negate a 4 hour FU?
It would be a FU on the same time frame in the opposite direction. Or if we go to the lower time frame, we have to look for that opposite direction as well, right? With the retest.
No. Okay. The same time frame, okay, or two FUs in the opposite direction on the lower time frame. Okay. We doing let's keep it simple. Okay, we doing math. If we had a 60-minute FU, only a 60-minute FU can negate it. Okay.
Gotcha.
Or two 30-minute FUs, because if I add 30 plus 30 together, that equals what?
It's an hour. 60.
That equals 60.
I see what you're saying.
All right, that makes sense. Everybody, that makes sense.
That makes sense.
Okay, so let's talk about our bias, right? If I'm on a 60-minute chart, okay, I'm on a 60-minute chart, and let me just mark out a zone.
I really just be trying to stall for her to keep you on here as long as possible.
All right,
Never
so
really
let's
mentioned
look at this area right here, because it's, and I'm just picking random areas, but this is going to show you how powerful this concept is, right? All right, so boom, I got this area marked here, and we see, let me mark this so y'all see that this is a FU to the upside. All right, everybody see and we clear that this is a FU to the upside right here.
Yes.
Okay, now is this a strong FU, or is it an attempted FU?
It's a strong FU.
Good, it's a strong FU. Why is it a strong FU?
Grab liquidity, close above the
It grabbed liquidity and it closed above
the body
of the previous candle. Everybody clear there? Give me a Y in the chat box. All right, good. So now this is a 60-minute time frame. So now let's go down and look at the 5-minute time frame in that same area. Boom, here we go. We got a 60-minute FU that formed. And what do we have on the 5-minute time frame? Is this a strong FU or a attempted FU?
Strong to the downside.
It's a strong FU, okay, on the 5-minute time frame. Okay. Now, this is why time frames are so important. Okay, because somebody in here would have said, man, I'm looking on my execution time frame. I see a strong FU to the downside. So I'm just getting ready to get short in the market. So I'm going to sell.
That's exactly how I think.
Okay. But the 60-minute time frame is what? A strong FU to what?
We're going up on the
to the upside.
Right.
Okay, so we always follow higher time frame manipulation. That is the most important. Okay, that is the most important. Now, with that being said, do you see how this strong FU to the downside can't negate, or it didn't negate, the 60-minute FU to the upside?
Right, because it was more the 60 minutes more powerful than that.
Because the 60-minute is more powerful. Does that make sense, y'all?
Mm-hmm.
Okay. So your entry, so good. Somebody said, where would my entry be? I marked out the entry area on the 60-minute time frame. This little rectangle box down here is our entry area, and our stop would be what? Right below here.
Gotcha.
Okay. So if anything, you could have took an entry here. Let me show y'all how. And this is when you start really making serious money. Okay. Entry here with a stop loss here. Okay. And look at the upside potential here.
Right.
Risking a little bit to make a lot.
Mm-hmm.
Okay. That's the name of the game, risk to reward ratio. Once you really hone in and understand manipulation, and you can follow manipulation, you are going to start consistently making money, right? But the more that you can hone in on your analysis, just like I did here, this is when you're going to start making very serious money. Okay. Because guess what? I can risk 10 contracts, which is going to pay me $500 a point. Okay. So my risk is essentially $500 because my stop loss is only a point, right?
Mm-hmm.
Okay. And we got a profit potential from 41.12.50 to 41.38. Right? So that's what? 25 and a half points. 25 and a half times 500 is what?
What is that? Somebody put that in the chat. Make sure participation, drop that in the chat. Grab your calculators.
So nobody in here know math.
I wasn't trying to do it. There we go. Tony got it right there.
All right, good. So we talking about risking $500, okay, for a potential payout of what? $12,750. Okay. Or if you was trading one contract, you're talking about risking what? $50 for a potential payout of what? $1,275.
This is what I gotta get to. I gotta get to this level right here. We gotta get here consistently.
No, for sure. All right, somebody asked the question, how did I come up with that entry? Simple, okay? My 60-minute time frame, okay? My higher time frame formed a FU to the upside, okay? And within this time frame, I was looking for what? A retest of this area, okay? A retest of this area in order to go long. All right, next question. No, my stop is always below the wick or above the wick, Tony. Okay. My entry is a retest of the body. Okay. My entry is a retest of the body that formed the FU. Yeah, Misha, save that question. All right, any more questions? Jerlisa Riva said, where would I have taken profit there? Would you base it on a 5-minute chart or 60-minute? So that depends on your risk tolerance. Okay. So if we was to look at the 5-minute chart, let's go back and look at the 5-minute chart. Look at profit areas. Okay. Let's look at some potential profit areas. If I was looking at my 5-minute chart, solely, most likely I would have taken profit here. Okay, which was a retest of this strong 5-minute FU to the downside. Okay, because my initial train of thought, if I was just solely looking at the 5-minute, would that the market would come back and test this area and move down. Okay, so if I was to take profit on this particular trade, I would look back at a retest of this strong 5-minute FU to the downside. Okay. Rashida say, do FUs only occur at support and resistance? Rashida, that's actually a very good question. And again, this is going to be, I'm going to go further into it in another class or a separate video. But I define true support and resistance with FUs. Okay. I define true support and resistance with FUs, not how people traditionally look at support and resistance. Support and resistance, I define support and resistance with manipulation areas in the market. So yes, FUs are how I would define support and resistance areas. Okay.
So when's your book coming out?
Hopefully it'll be ready in July. That the indicator is going to be ready before the book. I thought the book was going to be ready before the indicator, but the indicator for the high confirmation setups is going to be ready before the book.
Turn this session to a podcast. All right.
All right. So let's talk about homework. Okay. Whatever trading platform that you use. Okay. Now the homework, this is an exercise to help you gain confidence in execution when you see these FUs form in real time. Okay. Because a lot of you still have paralysis through analysis or are unsure. Okay. So homework, I want you to go to your S&P 500, S&P 500, you can look at gold or you can look at the bonds, okay? And I want you to look at 2 time frames, okay? I want you to take a look at the 60-minute time frame, okay? And then I want you to take a look at the 5-minute time frames. And yes, I do want you all to screenshot these and email them, email your homework in. Okay, I want you to go back over the last week, okay, and identify all of the FUs on the 60-minute time frame, okay, and I want you to go over the last 2 days and identify all of the FUs on your 5-minute time frame. You can choose any market. You only need to choose one market. Okay, it can be the S&P 500, it can be gold, or it can be the bonds. Okay. Yes. Identify strong and attempted FUs. Okay. Now, the purpose of this exercise is for you all to go back in time and see how these FUs started some of these moves in the market. Okay. Because guess what? It's easy to see this while I'm teaching and we're going through class, etc. But it's all about executing in real time. And if you can see that these FUs gave you an opportunity to make money more often than not, when you start to see them develop in real time, you will become more confident in executing them. Okay. Learning to accept your losses, but knowing that, hey, these FUs are truly my edge in the market. These FUs, more often than not, gives me an opportunity to make some money in the market. Okay. So again, this plays a part into the building your confidence side and understanding and training your eye to see these FUs. Okay. And again, this is just going to become easier and easier the more you do it. Okay. But when I discovered this and I started to build my confidence in taking these trades in real time, I simply went back and started identifying FUs, right? And was able to see how more often than not, FUs gave me an opportunity to enter the market and make money. Okay. Oh, I'm sorry, Denise. Let me get Denise on here. All right, Denise, you got the mic.
Thank you. Thanks, Zach. So on the Mastering Liquidity video, which was really excellent regarding this topic, you had shown us how you were able to predict whether or not a move in one direction would be continuous or would reverse halfway based on previous manipulation on the other side of the up move. So in other words, you could look as the market was coming down and see how much manipulation there was going on, and then predict how much manipulation there would be on going up the other side. Do you remember that towards the end of that video?
Right. So you saying, so for example, if it was a FU to the downside, I could pretty much tell you how
Right. In
much-
other words, right,
okay.
how far down it would go based on manipulation on the way up. Because you're saying if there was no more liquidity to be grabbed on
Yes.
the way down, then you know it's going to
Yes.
go all
Yes.
the way down. It's not going to stop. Can you just review that? Because that was very powerful, but I
Yes.
didn't get it entirely. Yeah.
Okay, yeah, for sure. Okay, all right, here we go. Because you got me expanding on what Gary was talking about. So this is about what she's referring to is knowing whether or not the move is going to continue or if the move is likely to reverse. Okay. Let me take, okay, this is a good example today. All right, so on the 5-minute time, let's take a look at the 5-minute time frame. Okay. Again, I want y'all to write this down again. I already said it one time tonight, but write it down again. Low liquidity equals institutional move. A low liquidity move equals institutional move. High liquidity move equals retail move. Okay. Now, Denise, how do we define high liquidity? Or how do we define liquidity? What liquidity areas are we targeting? What's the two main liquidity areas that we look for or that allows us to see liquidity?
Dojis and tops and bottoms. Double tops and double bottoms.
Dojis, double tops, and double bottoms. Okay. So I'm just gonna take this stretch of S&P 500 here, right? Now, look at this. This is a attempted FU. This is a strong FU to the upside. Okay. We got another attempted FU here. Okay. So this move from the bottom all the way up until this area, was this a high liquidity move or a low liquidity move?
Well, it has dojis, and it actually doesn't have a lot of dojis. So maybe we'll call it low liquidity.
Yep, it's a low liquidity move. Okay, because we see constant manipulation to the upside. Okay, we see constant manipulation to the upside. There wasn't much liquidity generated. And what do I mean by there wasn't much liquidity generated? They didn't give retail traders much of an opportunity to enter. Okay, because listen, think about this. Especially you all who has had previous trading experience, right? Prior to me, before you knew about the FUs, if you were just to look at this stretch of candles here, this move here, where was your entry? You didn't have one. Okay, you didn't have an opportunity to enter the market. Okay, because this move up was what we would consider a low liquidity move. It's a low liquidity move because it didn't give retail traders much of an opportunity to enter the market, unless you just one of those traders, oh, the market going up, or I think it's going up, so I'm just going to enter. But you didn't have a retail setup in this move here to enter the market. Okay, so this is a low liquidity move. So guess what? The market really on the 5-minute time frame, right? This is all we're looking at now, and it may paint a different picture on different time frames. But the market didn't really give us a reason on the 5-minute time frame to come back down, did it?
No,
it didn't. Okay, it didn't. Okay, so when we see that, again, if I'm looking solely at my 5-minute time frame, there was no reason on my 5-minute time frame for me to look for a sale, okay, as the market moved up. Okay. With that being said, if I was in a long trade, if I was in a buy trade, the market didn't give me any reason to get out of the trade because we didn't generate any liquidity on the way up. Okay. And we know what the market is always in one of three states. It's hunting liquidity to the upside, hunting liquidity to the downside, or what is consolidating. So
Okay.
so think about it this way. If the market is making a low liquidity move, right? And let's just say we did get in down here or we got in here, right? Most of you all will say, man, I'm up $200. I'm up $300. I'm up $500, right? And you start getting dollar dead. That's what I like to call it, dollar dead, right? And you like, oh, what, $500? Oh, this is the most I ever made on a trade. Let me get out of the trade, okay? But the fact of the matter is the market didn't give us a reason to get out of the trade. The market didn't give us a reason to sell short, okay? The market didn't generate any liquidity on the way up for us to turn back around and target.
Well, there was some dojis. I see a couple of dojis. There's a red doji in there, and there's a green doji in there.
Yeah, you see the dojis, but what also do you see? The manipulation to the upside.
So you're saying that negates the doji effect?
Yep, because that was that earlier concept where I was talking about calculating liquidity. A doji doesn't negate manipulation to the upside. We always, rule number one, we always follow manipulation.
Okay.
Okay, not to say that the market won't come back and target those dojis. I'm going to be short in the market on Monday because of what? My higher time frame analysis, right? So eventually all of these dojis will be taken out. But if I'm just looking at this 5-minute move here, Denise, the market didn't give me a reason because it didn't generate any liquidity for me to target my shorts.
Okay.
Okay. And here, let me give you all another piece of information as well. So y'all can go back and watch this. Let's look, you see this doji, let's talk about this doji right here, right? You see this doji, that's probably one you were looking at, right?
Yeah, yeah.
Okay.
And the red one, yeah.
Okay, which, this one right here?
The red one, yeah.
Okay, good.
Because that one might trip me. The red one might trip me.
All right, so let's look at it like this. Denise, what is this red bar right there?
That's a FU to the upside.
Well, it is an FU to the upside, but what is the red bar?
It's a red candle going down. What do you mean? What is it?
Yeah, it's an institutional zone or an order block.
Oh, I see. Order block. I see what you're saying. Okay.
Okay. So this doji simply came and did what? Tested our order block and moved higher, right? Okay. Now let's take a look at this doji here. The green doji. Oops. Now the candle before that doji was 42.72. You see that?
Yes.
Okay. The base of that doji was 47.72 and a quarter. Okay. So how many ticks is that between? That was one tick. Okay. That's one tick between the low of the previous candle and the low of the doji. That is low liquidity.
Oh, I see.
Okay. It didn't give retailers, even though it's a doji, it didn't give retailers an opportunity to enter.
Okay.
Okay. Now, Listen, y'all got me answering all kind of questions tonight.
Well,
But it's all
there's
good. That's what I'm here for. This is a order block because why? This is the last random red candle before what? The move higher.
Mhm.
Okay. And it's and we don't just mark them all out, right? But it's also an order block because it's the last red candle, plus it's followed up by what?
An FU.
It FU to the upside.
Mm-hmm.
Okay. So Tony, listen, we want to the order blocks. And I thought I did this in the video the other day. I could be mistaken, or it might have been in the live trade room. Okay. I only want to mark out order blocks that have some type of manipulation in the same area. Okay. So we look, if I'm solely looking at this 5-minute time frame, I got a random red candle before the move up, and the move up was started by what? A strong FU. So this is the only order block that I want to mark out in this area. It's no need for me to mark out this doji order block here, because there was no manipulation on this time frame that happened within that area. Does that make sense? Okay. Go ahead, Denise.
Okay. Yeah, I'm just looking for no manipulation. You mean there's no FU in that area?
Correct.
Okay. I gotcha. So, so it sounds like you really, even though you might understand FUs, you need to understand FUs in the context of other things, such as FUs versus dojis, FUs versus order blocks, FUs in the context of what else is going on in that area.
Yes, correct. Because we don't just randomly take just take random FUs. Okay. The first thing is, if we want to look at our FUs, the first thing to master is following manipulation, starting with our higher time frame. Okay. That's the first thing to master. We want to look at our higher time frames and find the most recent FUs. Has the market been manipulated to the upside, or has the market been manipulated to the downside on our higher time frames? Okay. And
Yes.
then when we start to mark out our institutional zones, okay, we only want to mark out institutional zones, IZs plus manipulation. Okay. And why do we only want to mark out these zones? Again, this is a game of probabilities. So I only want to take the highest probability trades. Okay. Some of you all get caught up in just wanting to take every FU because you just want to get in the market, period. I only want to take the highest probability trades. I'm only giving you all the highest probability setups. The institutional zones that are going to be respected the most, the FUs that are going to be respected the most are these right here. An institutional zone with plus manipulation, it's a high probability that this particular zone is going to be respected. Okay. And we see it even on the smaller time frame here, right? The 5-minute, this doji came, tested this institutional zone, right? And it started a 30-point move.
Right. So that raises a question.
And this is just analysis on this is just an analysis on a 5-minute chart. This isn't taking anything else into consideration. Okay. 30 point move in the market. That's $1,500 per contract.
Right. So my question now then is, if you see something like that, either on a 5-minute or a 1-hour chart, would that be an invitation to enter? If you're seeing a FU at this location of an order block and there's no other manipulation in the area and the market starts moving in a direction, should you say, oh, this is a great entry?
Yeah,
low liquidity.
It is a potential entry, right? With your stop right below the FU. Okay,
Yeah.
it's only a potential entry if it fits the risk profile, meaning that I can enter the trade and I still have a positive risk to reward ratio opportunity, right? So once I seen this, I had one of my money lines up here, this green line up here, right?
Yeah.
Okay, so yes, I could have entered here and I had the upside potential here. Okay, so yeah, that's a 1 to 2, 1 to 2.5 risk to reward ratio trade opportunity. So yeah.
So really what you're looking for that kind of entry is a combo of the order block and an FU to the upside with no other manipulation. Are those the
Well,
criteria?
not necessarily no other manipulation. We want order blocks plus manipulation.
Okay, so the other so then it's going to be order blocks plus FU plus manipulation. That's a good entry.
Well, FU is manipulation.
I guess, yeah. Okay, so I guess I said it. Okay,
this one. Yep.
Okay.
Order block plus FU.
Order block plus FU. Okay.
That's it. Two things. Order block plus FU. Okay, that's the same thing as order block plus manipulation.
So that's your setup.
Correct. Or that's a potential area of interest for sure.
Okay. Okay. Very good. Thank you. Thank you for that.
No problem. All right, so that's gonna wrap it up for us tonight. I got some videos and emails that's going to be coming out to you all over the weekend. We're gonna be back on class on Monday.